What if I told you that the biggest reason most investors fail isn't the stock market, bad investments, or even low income? It's their own emotions. You've probably felt it before. That panic when your portfolio drops and you're tempted to sell. The excitement when a stock skyrockets and you feel like you're missing out. The regret of making an impulsive decision and watching the market move in the opposite direction. If you've ever wondered why, despite the stock market delivering around 10% annual returns historically, the average investor earns less than half of that. The answer is simple. Emotional investing kills returns. I'm Jiten Modi, your personal finance strategist, and today I want to help you overcome one of the biggest obstacles to financial success: your own emotions. Emotional investing is the silent destroyer of wealth. It convinces you to panic sell when markets crash and chase overpriced investments when they're at their peak. It makes you act on fear, greed, and short-term noise instead of sticking to a rational long-term plan. And worst of all, it tricks you into believing you're making smart decisions when in reality, you're sabotaging your own financial future. But here's the good news. You don't have to fall into this trap. Once you understand why emotional investing happens and how to protect yourself from it, you can make smarter investment decisions, grow your wealth with confidence, and never lose sleep over market volatility again. At its core, emotional investing happens because humans are wired to react to fear and greed. When the market crashes, fear kicks in. The thought of losing money is so painful that investors rush to sell, locking in losses at the worst possible time. When the market is booming, greed takes over. Everyone is making money, and the fear of missing out pushes people to chase overpriced stocks just before they crash. This cycle repeats itself over and over again. And the result? Investors buy high, sell low, and wonder why they never seem to build real wealth. Think about the 2008 financial crisis. As the market dropped by over 50%, millions of investors panicked and sold everything. Yet, those who held on and even bought more at low prices saw their portfolios recover and grow exponentially. On the flip side, during the dot-com bubble in the late 90s, people poured money into tech stocks with no real business models because everyone else was doing it. When the bubble burst, many lost everything. The problem isn't the market. It's the way investors react to the market. If you want to break free from emotional investing, you need to understand the psychological traps that cause it. Recency bias makes you believe that whatever is happening now will continue forever. If the market is rising, you assume it will never crash. If it's falling, you assume the worst is yet to come. Loss aversion means the pain of losing money is twice as strong as the joy of making money. This fear causes panic selling at exactly the wrong time. Confirmation bias makes you seek out information that reinforces what you already believe. If you think a stock will go up, you'll find plenty of articles confirming your view, ignoring any evidence that suggests otherwise. Herd mentality pushes you to follow the crowd. If everyone is buying, it feels risky to sit out, even when valuations make no sense. If everyone is selling, it feels foolish to stay invested, even when the market is on sale. Once you recognize these biases, you can start making rational investment decisions instead of emotional ones. The cost of emotional investing is massive. Studies show that over a 30-year period, the S&P 500 delivered 10% average annual returns. Yet, the average investor only earned 1%. What does that mean in real numbers? If you invested Rs 10 lakh at 10% for 30 years, it would grow to Rs 1.74 crore. But at just 4.1% returns, that same investment would only reach Rs 33 lakh. That's a Rs 1.4 crore loss, simply because of emotional mistakes. Now think about what that kind of money could mean for your retirement, your child's education, or your financial freedom. Emotional investing isn't just costing you returns. It's costing you the life you want to live. So how do you break free from it? The first step is to have a clear, written investment plan. Successful investors don't make decisions based on emotions. They follow a predefined strategy. They know their goals, risk tolerance, and long-term strategy before they even invest. This removes impulse decision-making because the plan dictates the action, not emotions. The second step is to automate your investments. One of the best ways to eliminate emotions from investing is to remove the need for constant decision-making. When you set up systematic investment plans, SIPs, or automated contributions, you ensure that investments happen consistently, no matter what the market is doing. This forces you to buy when prices are low and prevents panic selling when markets fall. I once worked with a client who panicked every time the market dipped. He constantly checked his portfolio, made emotional trades, and felt anxious about his financial future. The moment we switched him to automated investing, everything changed. He stopped checking the market daily, avoided panic decisions, and saw his wealth grow steadily without stress. Another powerful strategy is to reduce how often you check your portfolio. Markets fluctuate daily, but long-term growth is what matters. If you constantly watch the ups and downs, you're more likely to make impulsive decisions. Instead of obsessing over short-term noise, review your portfolio quarterly or semi-annually. Diversification is another key to reducing emotional investing. If you put all your money into one stock or sector, a downturn could wipe out your wealth. But if you spread your investments across stocks, bonds, mutual funds, and other assets, you reduce risk and make it easier to stay calm during volatility. And finally, having an accountability partner changes everything. Whether it's a financial advisor, mentor, or even a knowledgeable friend, having someone to talk you out of emotional decisions can save you lakhs in potential losses. Many of my clients have told me that a simple 5-minute conversation before making a big financial decision has saved them years of regret. Investing isn't about picking the perfect stocks or timing the market. It's about managing your emotions and staying disciplined through every market cycle. If you let fear and greed control your decisions, you'll buy high, sell low, and lose money. The exact opposite of what successful investors do. The truth is, markets will always have ups and downs. But if you don't have a structured plan, you'll constantly second-guess yourself, fall for market hype, and make decisions that destroy your wealth. And every day you wait is a day you could be building financial stability and future wealth. But here's the good news. You don't have to go through this alone. The best investors follow a disciplined, automated approach that keeps them on track, no matter what's happening in the market. And you can do the same. If you're serious about taking control of your finances and investing with confidence, here's what you should do next. If you need personalized guidance, you can book a free one-on-one clarity session where I'll help you build a structured, stress-free investment strategy tailored to your financial goals. If you prefer to learn on your own, I've put together a detailed ebook that walks you through how to avoid emotional investing, create a rational strategy, and maximize your returns over time. And if you want ongoing insights, real-time market updates, and a community of like-minded investors, you can join my exclusive WhatsApp group, where I share daily investing strategies and expert tips. All the links to book your session, download the ebook, and join the community are in the description. Take action today.